The bottom line on seller financing is sellers who are willing to include seller financing as a part of the transaction can expect a faster sale and higher net sales price. Hello, my name is Stetson and I'm your business broker. Many business sales under $10 million valuation include seller financing or a seller note as a part of the business sale transaction. Seller note and seller financing are interchangeable terms, but generally the seller note refers to the terms of the loan, interest rate, loan term, default provisions. And seller financing is the overall concept that the seller is extending a loan to the buyer. Buyers like to see seller financing included in the transaction. Sellers would generally prefer not to offer seller financing if they had a choice. Let's take a look at seller financing through the lens of a buyer first. As a buyer, they like to see seller financing included in the deal for these reasons. 1. The seller has skin in the game and is more invested in the buyer's long-term success. 2. The seller note is generally at a lower interest rate compared to SBA financing. 3. SBA loans generally carry an interest rate of about 9.5% to 10% with a 10-year term. Seller financing is generally in the 6 to 7% range, offering a 5-year term. Both loan types generally include a personal guarantee from the buyer, so they have similar default provisions. Also, SBA lenders like to see seller financing as they will also view it as additional risk mitigation in the purchase. Sometimes SBA even insists on seller financing with the note being on standby, meaning that no principal or interest is paid during the standby period, which is often 12 to 24 months. The standby structure reduces the negative cash flow for the new business owner during the standby period and making the transaction less risky to the lender. Sellers generally prefer not to offer seller financing for these reasons. Number 1, delaying in getting the cash out of the business. Number 2, sellers worry that a buyer could run the business poorly and damage the value of the company to the point where the seller note may never be repaid. 3, in the event of a default, the seller note generally stands behind the SBA loan from a collateral standpoint, which increases the risk the seller may not be fully repaid. However, there are some advantages to the seller as well. The interest rate in a seller note is generally higher than that return they would get in a cash account. Also, the capital gains in the seller note portion of the sale will spread over a period of time and generally at a lower capital gains rate. Again, my name is Stetson and I'm your business broker.